Accounts receivable arise when sales to customers are made on credit. Credit sales are recorded by increasing accounts receivable. However, not all accounts receivable are collected as every company wants to. That is why companies expect that a portion of their receivables from customers will not be collected. The uncollectible accounts are recorded as doubtful accounts, or more commonly known as bad debts. There are two methods to account for bad debts: direct write-off method and allowance method. The direct write-off method of accounting for bad debts records the loss on uncollectible accounts as an outright deduction to accounts receivable. That means it is directly charged to bad debts expense. Crow Company's accounts receivable of $100 is found to be doubtful of collection. There is no journal entry in this problem since under the direct write-off method, the accounts receivable balance is directly written off to bad debts expense only when the uncollectability of the account becomes uncertain. The accounts receivable is only found out to be doubtful in this case. Continuing the example, Crow Company determines that it cannot collect $50 receivable from customer A. Using a direct write-off method, Crow recognizes the loss by debiting bad debts expense and crediting accounts receivable. The debit entry in this method charges receivable that are deemed uncollectible to the current period's bad debt expense. The credit removes the balance of the accounts receivable account in the general ledger and subsidiary ledger account for each customer. Accounts receivable that are written off or considered uncollectible are sometimes collected. This can be due to the collection efforts of the company or the customer voluntarily paying the previously written off debt. Going back to our example, Crow Company collected the amount that was previously written off from customer A. Two journal entries will be made. The first entry will be a debit to accounts receivable, customer A, and a credit to bad debts expense. This is to reverse the entry that was previously made when the receivable was outright written off. The second entry will be a normal recording of the collection with a debit to cash and a credit to accounts receivable. Aside from those two entries, you can just use a single entry to record the amount recovered and received. You can just use the entry debit cash of 2,500 pesos and credit bad debts expense. The allowance method of accounting for bad debts records an estimate of bad debts expense in the same accounting period as the sale. An estimate is used because management does not know if it can collect the receivables in full. Unlike the direct write-off method, which recognizes bad debts only when it becomes uncollectible, the allowance method requires the reporting entity to already make an estimate of the uncollectible accounts in advance based on a reliable estimation method. This is done in order to better reflect the realizable value of the accounts receivable. As the name implies, an allowance is recognized together with the bad debts expense when the collectability of accounts becomes doubtful or questionable. The entry to record the accounts that is doubtful of collection is debit to bad debts expense and credit allowance for doubtful accounts. When it becomes certain or identified that the accounts are really uncollectible, as opposed to being the collection only as doubtful, the entry to write off would be debit allowance for doubtful accounts and credit accounts receivable. In 20X1, Crow Company's accounts receivable amounting $400 is found to be doubtful of collection. The journal entry would be a debit to bad debt expense and credit the allowance for doubtful accounts of $400. The allowance for doubtful accounts is a contra asset account, just like the accumulated depreciation account that was discussed in the previous topic. This contra asset account is used instead of directly reducing the accounts receivable under the allowance method. When accounts are deemed uncollectible, they are written off against the allowance for doubtful accounts. Continuing the example, Crow's management found out that the $400 is deemed uncollectible. The journal entry would be debit to allowance for doubtful accounts and a credit to accounts receivable. When it becomes certain that the accounts receivable becomes uncollectible, the AR balance should be offset against the allowance for doubtful accounts. How about if the written-off account was suddenly paid by the customer? The $400 that was previously written off by Crow was subsequently recovered. When the customers suddenly pay an account that was previously written off, Crow's first move is to reverse the previously made write-off entry and the second entry to record the collection of cash. Here's a tip. Do you ever wonder why companies sell on credit even though they expect that some receivables will become uncollectible? Well, granting credit will increase total sales and net income. The increase in net income will be enough to cover the bad debts.